The one thing about the stock market is it's a marketplace, and marketplaces obviously are where buyers and sellers meet and prices are set. The fact that prices are moving up and down a lot often scares people and incites behaviour. You need to always remember though that just because stock prices are measured at very regular intervals and there's a lot of data available doesn't change the fact that you're buying a company and that the risk doesn't change. If you delisted BHP and only published the price once a year, its risk would be exactly the same as if it traded millions of shares a day and there were a whole lot of price observations. People do, unfortunately, get obsessed with volatility and have come to connect it with risk. The fact though that you've got liquidity, that you can sell positions is a good thing, not a bad thing, and something that investors shouldn't be scared about just because prices are moving a lot. The other thing I think to remember is that when prices go down, as a buyer, you should be happier. If you're buying the same company at a lower price, generally it's got to be good for your prospective returns. Unfortunately, we've come to be very influenced by the behaviour that we love things that are going up and think that they can always go up in an onward and upward direction. That's not real life. Things will always go down, but if you are a longer term investor, you've always got to look at it and say, if I'm buying the same company at a more attractive price and nothing in the long run has changed, I shouldn't be scared by the fact that the recent moves are down. That, unfortunately, is the reality of behavioural finance, that people will always be influenced by those prices, but it's very important to not associate volatility with risk.